This is the Bloomberg Daybreak podcast, available every morning on Apple, Spotify or wherever you listen. It's Thursday, the 18th of April here in London. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, more Federal Reserve policymakers add their voices to the growing consensus that progress on US inflation has slowed.
Bank of England Governor Andrew Bailey says that Britain now faces less of an inflation risk than America.
Plus, swinging the axe again, UBS gets set to make more job cuts as part of its ongoing Credit Suisse integration.
Let's start with a roundup of our top stories.
Federal Reserve policymakers are increasingly making the case to hold off on cutting rates. On Tuesday, Chair Jerome Powell said he needs to see more evidence that the pace of price rises is cooling. Now he's been joined by Federal Reserve Governor Michelle Bowman. Speaking at an event in Washington, she too conceded a lack of recent progress.
What we've seen over the first few months of 2024 anyway, is that progress on inflation has slowed. And I expect maybe it's even stalled at this point.
Michelle Bowman's comments were echoed too by the Bank of Cleveland President Loretta Mester. Speaking at a separate event, she said the central bank shouldn't be in a hurry to cut. The shift in tone from rate setters comes after 3 months of surprisingly high inflation readings and jobs data suggesting the US economy remains resilient.
The UK and Europe are facing less of an inflation risk than the US. That's according to the Bank of England Governor Andrew Bailey, whose remarks suggest that the UK will cut rates before the Fed. UK inflation came in stronger than expected at 3.2% in March, but Bailey says that he expects price rises to be significantly cooler next month.
We're in a position where we're seeing this process of disinflation. I expect that next month's number will show quite a strong drop because we have a particularly unique household energy pricing system in the UK.
Andrew Bailey also agreed with the International Monetary Fund's analysis, suggesting that demand is overheating in the US, but is below potential in the UK and the Eurozone. Sterling edged down after Bailey's comments.
Slovenian central banker Boštjan Vašle says the ECB can't disregard monetary policy and inflation in the US when making its decisions on interest rates. He told Bloomberg that divergence has its limits. This as ECB President Christine Lagarde says the Eurozone economy is getting back on track after a year of stagnation.
Growth in Europe has been mediocre and has been much slower than growth in the United States. We haven't had a recession, but it's been very slow and meager. And in terms of where we see Europe going forward, it is recovering, and we are clearly seeing signs of recovery now.
Lagarde's comments come as traders bet the ECB will cut interest rates at its next meeting in June. Officials are very carefully watching euro exchange rates as Federal Reserve policymakers signal they will wait longer to cut US rates. Traders are pricing in 80 basis points of reductions from the ECB across this year.
European Union leaders are pushing for a new joint defence and industrial strategy at their Brussels summit. A draft seen by Bloomberg calls for a paradigm shift in the face of losing their competitive edge to China and the US and wars both near and far. The text is yet to be agreed, with both Eurosceptic and frugal countries opposing what could amount to the bloc itself issuing hundreds of billions of euros in debt.
UBS is planning another round of job cuts as it continues to trim headcount following its rescue of Credit Suisse. Bloomberg's Tima Adebayo has the details.
The emergency takeover of Credit Suisse by UBS added around 45,000 people to the combined bank's workforce. The bank is aiming to save $6 billion a year in staff costs over the coming years, but hasn't said how many jobs overall will be affected. In this latest round of job cuts, sources have told Bloomberg that more than 100 employees at the firm's global investment bank will go. Whilst exact timings aren't final, it's thought the changes could take place in the coming weeks. In London, Tiwa Adebayo, Bloomberg Radio.
Here in the UK, Chancellor Jeremy Hunt says that consumers shouldn't be made to pay for Thames Water's mistakes. It's the most direct public comment from the top of government so far on the fate of Britain's largest utility. James Wilcock has more now.
The question hasn't changed since Thames Water's owner first went into default. Who is going to pay for its debt? The Chancellor gave a clear answer overnight. It shouldn't be customers. But its shareholders call Thames uninvestable and they refuse to put in more money too. As the standoff continues, Bloomberg has learned hedge funds have started shorting other UK water utilities and their debt. It's a sign some think Britain's water problem could get far worse before it gets better. In London, James Woolcock, Bloomberg Radio.
Now, in a moment, we'll bring you the latest on what central bankers have been saying about inflation and interest rates. Plus, we'll look ahead to today's EU Leaders Summit. But another story that caught our eye this morning, if you're in the market for a luxury purchase, well, who's not in the market for that? Apparently, Japan is the place to go.
And I've just been, as I said,
of
dripping in
course.
Chanel here in the radio studio this morning. No, not quite. But this is to do with the sharp fall in the yen, combined with the number of premium brands that haven't yet adjusted their prices to reflect the change, which means that there's an opportunity to get these luxury goods at a discount. A Tag Heuer Carrera chronograph watch in Tokyo sells the equivalent to just over $5,000 after the 10% duty-free discount, which is around $1,300 cheaper than it would cost if you buy it in New York. So our colleagues Claire Ballantyne and Lisa Dew have been reporting that the savings are bringing buyers from around the world to Japan, with some eager to resell their luxury goods then for a profit when they get home.
Ooh.
Now, the experts in this field say that essentially luxury brands will catch up. So it's a
Yes.
closing window because they don't want price arbitrage between different countries as well. So there's a whole list of the things that you can buy in Japan at the moment at a discount versus where you'd buy them in
Hang
the
on a
US.
sec, you've skipped over the whole fantastic
Dripping in
trip
Chanel.
well, the fantastic trip to Japan. Highlight of Japan? I know you were
Oh,
there.
the food.
recently. Really?
Yeah, everything
Oh.
I ate was fantastic.
Amazing. There you go. So giving you some inspiration for your travels then. And let's think about central banking though, shall we? Next, a divergence has emerged among the world's top central bankers over their view of where inflation is going, and they might be able, and when they might be able to cut interest rates. We've been hearing from the Fed, the ECB, the Bank of England policymakers during events linked to the IMF and the World Bank spring meetings at Washington. A whole plethora of voices, really. Joining us this morning, Bloomberg TV anchor Kriti Gupta for more on this. Firstly, on the Fed, we've seen other FOMC members like Mester starting to echo Jerome Powell's signals on inflation. So a bit of catch up by other speakers. Interest rate cuts might basically come later. How are markets seeing these messages?
They're running with it, really. And if you look kind of market pricing, you have no cuts priced now officially for 2025, at least those, or excuse me, 2024 until 2025. That seems to be what the markets are pricing in, simply because you have this massive kind of almost dark period in the back half of the year where, because of the election risk on both sides of the Atlantic, by the way, you are going to see a little bit of pushback in terms of whether or not you can use rate cuts or imply rate cuts as late as September is what people are saying. But again, it's not just about that opening rate cut. You have to kind of follow them up with consecutive ones. So that's why it's being pushed back not only to December, but even further out, given that they're waiting for those inflationary dynamics and because the data has come in hot. 3 data points, I think we can say, is fair to make a trend. And that's kind of the argument that a lot of these central bankers are saying. So Loretta Mester, not really saying anything new, but kind of really harping on the fact that there is no hurry and there is no rush. And therefore, she does ultimately still see that an interest rate cut could be on the docket, just not yet.
Not yet, indeed. How difficult has Jerome Powell and colleagues made it for other central bankers, though? Because although they love to say that they don't watch the Fed, they do in some ways.
They do, and it's tricky because traditionally the Federal Reserve has kind of been the central banker to the world naturally, and they were a little bit late to hiking rates relative to some of their peers, even their G10 peers, for example. You saw the BOE, of course, front running the Federal Reserve on that front. You saw the Reserve Bank of New Zealand, the RBA, as well, all front running the Fed in terms of hikes. But they all may potentially not do that in terms of cuts, although you are seeing that in, say, the Swiss National Bank, for example, already a cut there. And that already had caused so much ripple effects in the fact that the Swiss front ran the ECB as well. So I think at the crux of the question is, do you start to see the same growth dynamics in the entire world? And that's really where the divergence comes from. This idea that the United States, a lot of that growth, a lot of that inflationary push is one of growth, whereas the UK and other parts of the world as well, some of it is more commodity exposed, some of it is more housing exposed. And some of them is kind of still a wage story. There are a lot of places in the world, including the UK, where real wages haven't caught up, and affordability is a bigger issue than it is in the States.
Yeah, absolutely. Andrew Bailey making that very point, insisting the inflation dynamics in the UK are very different to the US, which is pretty interesting. There's also optimism too from Christine Lagarde. Her key message focusing on the Eurozone economy actually looking brighter, saying, we didn't go into recession, and so that Europe looking a bit stronger.
It is. And look, when you've looked at some of the data points and the economic data as well, look at the periphery, because the traditional kind of weak spots or sore spots of the European economy, I'm thinking of Italy, Spain, Greece, etc. Those are your outperformers this time around. And you're really just seeing kind of more weakness in Germany. And that's kind of bringing up the question, the age-old question, which is, does the ECB cater to the entire Eurozone or just Germany? And if you do actually, however, look at the data points, it is much, much stronger. This is where fiscal deficits become a bigger issue. And I think France is a really great example of what you're seeing there, because the spending is starting to become far more than anticipated. And that's where starting to seem you're seeing more issues in terms of markets pricing in particular. But Christine Lagarde, to her credit, is looking at the periphery, looking at the traditional problem spots and saying, oh, well, things aren't looking that bad there. Are we also in a hurry?
Yeah, interesting to see in her comments as well, this idea that although she points to the single mandate of the ECB being price stability, that the exchange rate is something that they take into account in terms of how it will impact inflation as well. So it brings us back to this question of central bankers watching each other in this too. Kriti Gupta, thank you very much for talking us through the latest of what we've heard from those central bankers at the IMF and World Bank spring meetings in Washington.
Well, let's stick with Europe. Weak growth, the fallout from Russia's war in Ukraine, and inertia about a capital markets union are some of the key issues on the agenda as EU leaders meet in Brussels today. It comes as a special report from the former Italian Prime Minister Enrico Letta recommends integrating the European energy market, consolidating the telecoms industry, and also this idea of joint borrowing to finance defence spending. Bloomberg's Oliver Crook joins us now from Brussels for more on the summit. Ollie, thank you so much for being with us. There does seem to be real concern in Europe, about its competitiveness, about its defence spending. Letta's report is also quite forceful. What are the key points of his recommendations?
Yeah, it's really a single market report. It's 147 pages, and it really goes into a lot of detail on a number of issues. And you've enumerated some of them. But really, I think that one where you might have the most consensus is this question of defense spending. Everyone knows in Europe you need to get that spending up. The question is, how do you pay for it? The question of joint debt is really the main question, I think, for many people in Europe. There is potentially some room to make progress on this. There are, of course, some of the nations that historically have been joint debt averse that are still standing in the way of that. But I think that there is a little bit more wiggle room on this, particularly on this reality of the new defense reality of Europe. There's also this question of the capital markets union. We've heard about it for about a decade. Will there be sort of more uniform financing rules and an ability for capital to move across Europe? This is seen as one of the main catalysts, not just for defense spending, but for attracting spending across all the sectors in Europe. There's also about energy market integration, telecoms consolidation. They're talking about there are 32 carriers at least across Europe. The United States has 2. These are all breeding all kinds of inefficiencies within the European market.
Ollie, what are the expectations around progress being made at this particular meeting on advancing any of those issues?
So what's interesting about the competitiveness issue, Stephen, is that it's a lot easier to put tariffs on Chinese goods than it is to look in the mirror and say, hey, we have a competition problem. And, the other former Italian prime minister who is also in charge of this is Mario Draghi, who gave a speech this week that was frankly very stark. But he was talking about a reimagining of Europe that has to be on the same scale as when it was founded 70 years ago with the steel and coal accord that really brought it into being. And unfortunately for Europe, this is exactly the kind of thing that they're really bad at, right? A massive issue, very difficult political negotiations, but no immediate urgency, right? So you have some of the issues like the capital markets union. Where will that be supervised from? This is one of the main contentious issues. Will it be in France? Will it be in Paris? Perhaps not. And the other point, Stephen, and this is something that I'm sure you're watching very closely, all of these recommendations call for a bigger, more centralized Europe, a Europe that acts more like a nation than an arrangement of nations. And that may not be the most popular view, particularly in light of the polls going into the election.
Yeah. Also, these European leaders have been discussing, the defence issues and the wars that we're seeing in the world, the Middle East, the concerns around Iran. On defence, what is the new goal for weapons production, for spending in Europe? How quickly is that changing? What's the sense of that at this gathering?
Yeah, well, it depends who you ask, right? We hear a lot of rhetoric from the politicians, but I was at a defense summit yesterday where I spoke to the CEOs of Saab and Kongsberg, the two sort of Nordic giants of defense here in Europe. And really their point was that, listen, we are willing to ramp up capacity. We've already started it, but we need two things. We need one, long-term stable order flow from the governments. And there's been a lot of talk. They do not have all the orders they need to justify the kind of ramp up that's required. And two, they need investment in financing, and they're not waiting for a capital markets union. They say you need to go for the lower hanging fruit. The European Investment Bank rules need to change so that that institution can invest into defense, and they need those long-term commitments so that they can start ramping up production for a historically very low volume industry that needs to suddenly churn out extremely high volume.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.